let's do a comparison between open-end and closed-end mutual funds. So this is going to be the open-end scenario, and over here in purple, I will do the closed-end scenario. So in an open-end scenario, if I think that I'm a good investor, I might go to some people and say, okay, I'm going to sell you some shares, and with the money I get, I will invest it. And so let's say initially, and I'm going to use really low numbers and unusually low numbers just to make the diagramming a little bit easier. Let's say I go to 4 friends, and I get $1 from each of them. Normally, it would be more like 4 million friends, but hopefully this will give you the general idea. So here are all the shares. So there's 4 shares, and I get $1 from each of them. I get $1 from each of them, so I am able to raise $4. And we would call right here, especially if the $4 is all sitting in cash, this $4 is the net asset value, of the fund. Now, why do I go through the trouble of doing this? Well, I, as the manager, can take a management fee off of the net asset value. So I might take, let's say I take 1% for myself annually. 1% annually, and that's what I use for my office space and to pay my own salary and to pay the junior analyst salaries, etc., etc. Now, this is the key point to an open-ended fund, or an open-end fund, I should say. Let's say a 5th person comes along and says, hey, look, I also want to participate in your fund. Well, if you're running an open-ended fund, you can say, okay, sure. Well, right now, our net asset value per share, our net asset value is $4. We have 4 shares. So our NAV per share is $1. So it's a $1, let me write it down here, $1 NAV per share. So if you give me another $1, I can create another share for you. So what I would do then is I would create another share for you. You would give me your $1, and now the net asset value of the fund is no longer $4. I had $4, but you just gave me $1. The net asset value is now $5. And notice the net asset value per share has not changed. $5, we have 5 shares. Now let's say I'm able to manage this quite well, and we go to a future state where I've been able to turn the $5, even after taking out my fees, etc., etc. I'm able to turn that into $10. I'm able to turn that into $10. So this is the $10 right over here. I've invested it well in stocks. So the net asset value is now $10. I still only have 5 shares. Let me draw the 5 shares here. So this is 1, 2, 3, 4, 5. And now what is the net asset value per share? Well, I have a $10 net asset value, and I have 5 shares. 10 divided by 5, we now have a $2 NAV per share. So let's say the person who happened to own this share down here says, okay, this is great. You've been a great fund manager, but I now need my $2. I need it to go, I don't know, buy a soda or something. And so this is the other key of an open-end fund. If this investor, the person who has the share, wants to get their cash back, they essentially give it back to the fund manager. The fund manager has to come up, maybe sell some assets, so $2 worth of assets. So the fund manager has to take this $2 right over here. The fund manager has to take this $2. So it will and return it to the person who owned the share. So the $2 will go to that person who owned the share, and then the share will be canceled. And then this share will be canceled. And so what had just happened? Well, now the NAV, so let me show all of this stuff down here has now disappeared. Now the NAV is $8 because we just had to give $2 to that person who wanted to redeem their share. Now it is $8, and there's 4 shares. So we still have a $2 net asset value per share. So the main key idea here with this open-end fund is if you want to buy into the fund, you transact essentially with the fund managers, and they will create a share for you, and they will take your money. If you want to redeem your shares, if you want to get your cash back, once again, you transact with the fund managers. You say, hey, okay, you claim it's a $2 NAV per share. Well, I want my $2 for my share back, and they will give it back to you. The NAV will shrink, and the share base, the number of shares, will shrink. In a closed-end fund, you don't transact in that way with the fund managers. It can start off very similarly. So let's do it in a very similar way. So let's say in a very similar way, when you create your closed-end fund, you go to 4 investors who each give you $1. So let me draw that. 4 investors who each give you $1. So you have a $4 NAV, $4 net asset value. Now, let's go through the same scenario. Let's say a 5th person says, hey, look, and similarly, the way you pay your bills is you take a management fee. Maybe it is 1% annually on the NAV. There's different ways that you might structure a fee structure, but to show the commonalities, let's do it the exact same way. But let's say that 5th person comes along and says, hey, I really, really want to buy into this fund you've created. Well, in a closed-end fund, once you've done your initial issuance of shares, you aren't going to create more shares like this, or at least you're not going to do it in a typical way. An open-end mutual fund can do this on a daily basis. A closed-end mutual fund typically will not create new shares. So this is the fixed pool of shares that it has. So if the 5th person wants to come in and buy into it, they are essentially going to have to go to one of the people who already own shares and buy it from them. So in a closed-end mutual fund, the shares you don't buy and sell with the fund managers once it's created. You then trade these shares. You trade the shares on a market, and it could be the New York Stock Exchange or the NASDAQ or anything else. Trade on a market. And the price per share on that market usually does diverge from the net asset value per share. In this scenario, the way I've constructed it, we have a $1 net asset value per share. But let's say people are feeling really, really good about this fund manager's ability to invest some money. So that the share that has a $1 net asset value might trade above $1. Maybe the person said, that person's so desperate, they're like, I want to pay $1.25 for a share like that. So it might trade at, let's say, $1.25 because there's so much demand to get into this fund. And so you can have a market price per share that diverges from the NAV per share. And in this case, when the market price is above the NAV per share, we would say that it is trading at a premium. We could think of another scenario. Maybe more people aren't buying into the share. Maybe the person who has this share right over here has second thoughts, learned new things about the fund manager that makes them a little queasy. So they're desperate to get out. And so when they trade on the market, they're just willing to get anything that they can get. And so let's say they sell for 80 cents per share. So it's 80 cents per share. So in this situation, when the market price has been, when the share has been traded for less than the net asset value per share, we say it has been traded at a discount. So traded at, I'll just use the at symbol, traded at a discount. Now you might be saying, hey, wait, Sal, I understand with an open-end fund, if the fund grows, I can redeem my shares. The shares get canceled, I get the money back. In this scenario, if I'm not transacting with the fund itself, how do I actually make money? Well, what the fund manager can do, and this is actually very close to what a typical publicly traded corporation will do, is as they earn money in this fund, they can dividend it out to the actual shareholders. So let's imagine a scenario. Maybe this closed-end mutual fund, maybe it buys a bunch of assets. The assets do well. So we'll think about the positive scenario here. And once again, let's say that those $4 grow to $8. Those $4 grow to $8. So we have an $8 NAV, and we still have 4 shares. That hasn't changed. So we still have 4 shares. Let me draw the 4 shares. We now have a $2 NAV per share. So we now have a $2 NAV per share. And these shares could be trading at any price. It could be trading at $2.50. It could be trading at $1. If it's trading at $2.50, it's trading at a premium to its NAV per share. If it's trading at $1.50 now, it's trading at a discount to its NAV per share. And let's say the fund managers right here, they want to start dividending some things out. So what they can do is maybe all of this $8 in assets, maybe it's stocks or something else. The fund manager can sell some of them. They can sell some of them. Let's say they sell, let's say they sell $4 worth of it. So then it turns into, it's still a $8 NAV, but let's say it's $4 in cash, and let's say it's $4 in stocks, $4 in stocks, and maybe they'll actually want to dividend out this $4 in cash. So they give everyone a $1 per share, $1 per share dividend. And this is very similar to what a publicly traded company might actually do, or any company when they issue a dividend. So after that has happened, the NAV for this company is now, or for this, I should say, closed-end fund, which is set up usually as some type of a corporation, the NAV is now $4 because we've given back $4 in cash, $4 NAV. We still have those same 4 shares, 1, 2, 3, 4, and so our NAV per share is $1. So we have a $1 NAV per share. And you would say, oh, wait, this doesn't sound so good. I had a $2 NAV per share before. Now I only have a $1 NAV per share. But what you need to remember is each of these shareholders just got $1. So they now have a share that has a $1 NAV per share, and they got another $1. So they still essentially by holding this, they have $2, assuming they were there when the dividend was actually issued. So what are the main advantages, disadvantages? Well, in an open-end fund, because on any given day, investors can redeem more shares, the open-end fund, I should say, has to keep some money in cash for the redemptions that might occur on that day. In a closed-end fund, there's a little bit more flexibility. And also, the closed-end fund manager doesn't have to worry as much about, well, hey, maybe people are going to take all the capital away and I'm going to have to sell a bunch of assets. The open-end fund has to worry about that. It's really up to the fund manager to decide when they do things like a dividend at a time that is right for them. So there's a little bit more flexibility right over here.